stockmarketHQ technical analysis for the week of January 15th, 2022. Let's start off by taking a look at the volatility index or the fear gauge and have a look at what we're looking at here. So we can see that the volatility is kind of a little bit on the rise here. It's not particularly high, but it's kind of in a neutral position. What is a little bit more interesting is that if we take a look over at this pattern here, we can see that the momentum on this has turned up and is an uptrend, which is looking very similar to this kind of pattern over here. And then if we look up towards the actual volatility index, you can see a couple things here. First of all, we've got this pattern that follows with a little bit of a rising trend. Like so, before it actually goes and takes off to a much higher spike peak. Now, these spike peaks generally happen sometime around the third week to the first week of each month. We can see there's October, there's the third week of August, third week of September as well. What's kind of interesting about this is that this current increase in the volatility that we're seeing here at the moment is at a higher low than what we saw back in November. So what that does is that tells me that there's quite a bit more uncertainty than what we've had previously. That could be because we're heading into earnings season here. Earnings season is generally a time with a lot of volatility. Prices fluctuate very quickly based on headlines, earnings reports, whether or not companies raise their guidance or whether they beat their analysts' earnings per share estimate. So at some point in the next couple weeks or so, we can probably look at some kind of increase in volatility, and that would generally correspond with the earnings reports out of the big tech companies like Apple, Amazon, Facebook, which all happen sometime around the 26th till the 1st of February in there. Next, we want to have a look at the NASDAQ McClellan oscillator, which tells us whether or not the market is overbought or oversold. And generally what I take a look at is whether or not the market is in a what I can call the buy zone or the sell zone. I'll just label these here quickly so you guys can keep track of them. All right, so as we can see right now, we've got the market is currently kind of at a neutral position here, somewhere around minus 16. So it's into that slightly oversold territory, or slightly oversold territory, but it's not down into our buy zone here. And again, what we're looking at is we really like to see these patterns. They go up for 2 or 3 months, or shorter periods of time. We can see we're in this similar kind of pattern where the market is in an uptrend. So with each one of these decline, as we've got to rise up towards the sell zone, the market becomes overbought, then it becomes, then it sells off, drops down to the oversold condition. But as we see this rising uptrend here, with each one of these pullbacks, sellers become less and less kind of fearful, and they are less reluctant to sell. So the market becomes less and less oversold until what finally happens is there is some kind of catalyst that actually comes into the market and causes the market to sell off and break down below that trend line. and then the market effectively resets itself. Now like that before recovering again. So this is the zone that we like to buy in. This is the zone that we like to sell in. It's not really a time to buy, not really a time to sell yet. We want to take a further look at the also the MACD momentum. We can see that the momentum indicator is definitely in a downtrend there. So if that crosses below that zero line, as you can see here, cross below that zero line at almost the same time that it broke below this previous uptrend. And when that happens, that would be a sell signal, and we could expect the market to decline even further. Looking at our S&P 500 index, so we've got lots of stuff going on this chart here. First thing I always like to take a look at is the money flow index. The money flow index is really good at showing us where the money is flowing or what the trend is actually doing, where the big money, whether money is flowing into the stock or out of the stock. And just as a reminder, when it gets down to this 20 level, that means that the market is oversold. And when it's up at this 80 level, that's when it's overbought. So we can see back in November, we had an extreme overbought level there just before Omicron kind of came out. And back in September, we had our kind of extreme low position there, the oversold, and you can see money flowed into the market, got to the extreme overbought. So that's where we like to buy, is down at these extremes on the oversold conditions and sell at the overbought conditions. So what we're looking at on the money flow index is we really need to see, for the market to move up higher, what we need to see is we need to see a trend reversal here, where this money flow goes from this neutral box where money managers have not been putting any money into the market for about the last 6 to 8 weeks, or no, new money, I should say. In order for the market to go higher, we need to see that money flow start to increase into the market. If not, if it continues in this downtrend, then it will get to the oversold condition, which would be the first indication that the market's probably going to drop a little bit down to technical support levels. Next thing we like to look at is the on-balance volume. So again, as we kind of look over here, we can see that, so the on-balance volume tells us whether or not big financial institutions or big money managers are buying shares or not buying shares in the stock market. And we can see that we've got a very definite downtrend in this on-balance volume here for about the last 6 weeks or so. So again, this is one that we're going to want to keep an eye on. If big managers start to buy stocks, then that's going to cause the stock market to go up. Of course, if they start to sell stocks, then the market's going to decline. The market is always a function of supply and demand. We've also got a really interesting chart pattern here. So what we've got is we've got a stock market is in an uptrend, and each one of these lows in the market is what's called a higher low. So each low is higher than the previous low. As we kind of see here, this low is higher than this low, which is higher than this low, which is higher than this low. And that tells us that money managers are coming in and they are not only buying the dip, but they're not allowing the dip to drop down as far as previously before they start to come in and buy. But there is a certain level where the big money managers are just stopping buying. And that's right around this kind of 4,700 level here. So you can see each time that the stock market reaches that level, the big money managers say, that's it, we're not buying anymore. Again, here in December, they say, no, we're not buying here. Up here, we've got what's called the Santa Claus rally, which we've talked about previously in the stock market update on December 12th. So we really are at an inflection point in the market right now. Because what we've got is we've got this wedge pattern here. And what generally happens is in this wedge pattern, either the market either breaks out or breaks down from that wedge pattern. So this is generally what happens. The tighter that this wedge gets, or the closer to the apex this wedge gets, the closer the market is to making one of those moves. So if the market does break down, as we look at these indicators, if the money flow starts to come out of the market and if institutions start selling shares, then the market is likely to pull back, and we would probably be looking at a technical support level somewhere in the vicinity of around this kind of 4,500 mark, which would be about a 5 to 6% decline in the broader market index. And what effect that has on the individual stocks, you kind of have to look at see what the support levels are for that. If the market breaks out on good earnings reports, then we're going to see the markets start to continue this uptrend up to not only previous all-time highs, but up to new highs as well. But there has to be a catalyst. There always has to be a catalyst that's going to drive that market higher. And right now we're looking at a number of actual headwinds in the market. We're looking at earnings reports where earnings are going to be affected by the Omicron virus, forward guidance for the next 3 months, and we're looking at future interest rates. So there's going to be commentary from the big corporations, the CEOs on their earnings conference calls, and they'll have that information, and the market is going to react to that, and the reaction is going to be seen in the actual selling of shares or in a decrease in money flow. We also want to take a look at the MACD momentum indicator. So again, this MACD momentum indicator is very clearly in a downtrend here. And we had the first indication was a sell signal back in the first week of January, and this black line crossed below the red line. If this black line here crosses below the zero line, then that would be a sell signal confirmation. So that would signal that the market is going to actually decline and into some kind of a downtrend for a certain period of time. We can see a good example of that would have been back in September as well, when that black line crossed below the red line there, and then it crossed below the zero line back in the third week of September, and the market continued down there before reversing. So again, we're very close. We could also have the same effect here where it bounces right off the zero line. We'll have to wait and see what happens with that. As well, the final thing I want to take a look at that's going to be of interest here is this big line right here is called the volume by price. So that shows the total number of shares that were bought at a particular level or price in the market. So this area right here shows us, it's called a volume shelf. So it's a level or an area where there's been a large number of people that have bought, or investors that have bought shares. And what happens is that investor base becomes effectively the support for the market. So everybody who's bought shares in this area, in this zone, are all currently at break even. So if the market starts to drop below that level, then there's going to be all these people here, potential sellers or supply in the market, because they'll want to get out before they have their stop losses hit. And that then creates additional supply in the market. However, on the positive side, it also creates a support level, because if there's not a catalyst that drives the market down or gives the market a reason to sell, then that becomes effectively the support base, where investors, big money managers, are not going to want to sell their shares for less than break even if they see the market is going to go higher. That's all we have to look at for this technical analysis. Thank you very much, and we hope that helps you out in making your investment decisions.